They've already done that, frankly. Silver had a high back in October of last year at 35. It dropped. Came back up in March of this year, hit 35 again, dropped. In fact, it had a cleansing drop down to 27.50. And then came back up, and in June, it got up above 34 again. Again, not taking out the 35 plus highs. Okay, they were like 35.50 each. But at 34.90 area, we had a major momentum breakout of a structure that said, okay, silver's coming out of this congestion. By congestion, I mean, if you go back to May of last year, silver was 32.70 at a high. You could draw a line sideways through May of this year, where it was either side of that level, up and down, but really just net sideways. When it got back to 34.90 in late June, we said, that's it, it's coming out of here. Whoosh, it went up to 39. Now, as typical, the price chart guys like to sell round numbers or just in front of them. So let's risk 40, okay? It's a factor. I think still the real driver of gold over time, it's been money for 3,000 years, okay? Silver's been money too, also, backed by governments. By the way, Florida, Texas, and a whole bunch of other states have now legalized gold and silver as legal tender. Okay, a hell of a statement. That's like a rebellion. Hey, Fed, your money's not the monopoly money anymore, okay? But the real driver of gold is simply the ongoing degradation of fiat money units. In other words, look at an M2 chart, go back 50 years, just this explosive volcano of upward curvature. Okay, well, that's why when your granddad built a house, it was $4,500. Now it's $450,000. Okay, it's a degradation of the money unit, and gold simply reflects that. And there's a point at which finally the world will be smacked in the face, here, there, and finally everywhere. We need to get stability, and I think that's the real ongoing driver. Yes, what Fed does this time around, or what this happens over here, yeah, those are factors. But ongoing, that's really the driving force. It's an ongoing trend. And yes, gold will sometimes underperform that trend and then outperform that degradation trend. Right now, it's headed into an outperform probably, where its upward curvature is even more than the money supply growth. It's catching up, So anyway, I think that's where we are. And these other events we've been talking about, let's say a breakdown in the stock market bubble, we know what the central bank and the central government will do in those type of situations. We know what they've done in the past. Does it work? No, it never works. Stock market still implodes. They print money, they lower rates to nothing. It still goes down. And what's the beneficiary?
State-level action is surging. As of 2025, 11 states, including Texas, Utah, Wyoming, and others, have passed laws making gold and silver coins legal tender. Florida is set to join, with legislation taking effect in July 2026. Missouri, Arkansas, and others have recently enacted similar measures. These efforts reflect growing public concern over inflation and federal monetary policy, driving states to expand currency options.
Powell surrendered the other day. Okay, we all know that. Okay, that was basically a surrender speech. Also, he was being crowded by enough other voices on the Fed that was saying, there were two Fed governors. Now there's more that's saying, no, we need rate cuts. So he'll look kind of awkward if he found that half the Fed governors wanted a rate cut and he was still standing strong, because then it would look overtly political. Fair. So anyway, so he's now succumbed and he's saying, yeah, we're going to put our foot on the pedal again. Okay. But they got other tools as well. It's not merely interest rates, the artificial pricing of monopoly money. They've got other things, their balance sheet, so forth. And believe me, if some of these events start to unfold, these accidents from the side, like this bank has a headline, Bitcoin crashes, oh my God, what are the wave effects? What they do will be even more exaggerated than what it was in 2007 to 9. Remember, they finally came in with QEs. Adopted from the Japanese. I think it was after that October event in 2008. Finally, Bernanke said, okay, we got to do QEs. Did it help? No, we went down for another 6 months to the bare low. So it didn't help. What happened? Gold immediately turned and made a new high. Okay, so I think we're sitting on that type of event where suddenly things snap instead of incremental. And I don't mean have to crash. Now, Bitcoin could be an exception and maybe some banks, but that's when the central banks go berserk. And in this case, we have a president who, rather than standing back from the events, from the policy, is a full participant in wanting, free money.
Mhm.
So it'll be not just the central bank, but the central government wanting to push the throttle down. So that could be quite exciting, and you just got to be on the right side of these events to not be fretting about it. Enjoy it.
Mhm.
Okay.
Turning bullion into usable money is no longer a fantasy. Texas law permits the establishment of electronic platforms and debit card systems to let people spend gold or silver stored in state depositories. Florida's upcoming law similarly encourages digital payment infrastructure compliant with purity and tax rules. Though merchants are not required to accept metals, these modern systems craft a bridge between ancient value and daily convenience.
2008, there was that event. And that's one of very few events in the history of gold and the stock market relationship where there was a bad month or a bad 6 weeks where gold actually went down with the stock market. And it did. But at that point in time, gold had already had a massive advance during that first year of the stock market bear market. Stocks have been going down from October 2007 to early October 8, and then they had that crash event. A full year off the high and a big percent off the high. Gold was going up the whole time. It's only in that month, or August, September, then October, that gold participated. But for gold, it was a needed correction. Our technical showed that gold at that point said, hey, I need to correct. It used that as an excuse. And then when the Fed came in with QEs, after that October stock market event, stock market continued down into March, a good percent further, the March of 2009. Gold immediately turned and was back to its high within months, while the stock market continued down. So with the exception of that September-October event, if you looked at the bigger trend of gold from 2007 on to 2011, actually, gold was just continuing up. It took until 2013 for the S&P to finally get back up to the high it saw in 2007. Look what happened to gold during those years. Huge up. Okay, so I think that scary notion that, oh my God, gold's going to collapse, the miners are going to collapse because of the stock market. If the stock market crashes, and that's a big if, I'm not confident that it will. You can have a bloody bear market without crashing. This is a different situation this time. It's far more onerous than any other bubble situation we've ever seen. And I think the outcome is going to be different than we've ever seen before in terms of the real world consequences.
While these developments gain traction, critics raise valid concerns: fluctuating prices, capital gains tax liabilities, and federal authority over currency. Gold's volatility presents challenges in pricing everyday goods, and IRS still treats it as a taxed collectible. Moreover, opponents warn that undermining the dollar's dominance could hamper the U.S.'s financial and global standing.
They've already done that, frankly. Silver had a high back in October of last year at 35. It dropped. Came back up in March of this year, hit 35 again, dropped. In fact, it had a cleansing drop down to 27.50. And then came back up, and in June, it got up above 34 again. Again, not taking out the 35 plus highs. Okay, they were like 35.50 each. But at 34.90 area, we had a major momentum breakout of a structure that said, okay, silver's coming out of this congestion. By congestion, I mean, if you go back to May of last year, silver was 32.70 at a high. You could draw a line sideways through May of this year where it was either side of that level, up and down, but really just net sideways. When it got back to 34.90 in late June, we said, that's it, it's coming out of here. Whoosh, it went up to 39. Now, as typical, the price chart guys like to sell round numbers or just in front of them. So let's risk 40, okay? Okay, now we're trading either side of 39 right now on the September contract. We think the process has already begun that you were asking about. we think the acceleration phase in silver and the miners. Now, for instance, GDX has gone from a sleepy upside pattern to suddenly it's now up to near its 2011 highs. We expect GDX not to even stop until it clears its 2011 highs, meaning get up in the upper 60s. And same with the miners in general. Silver, we think in this move, in this acceleration phase for it and it relative to gold, is likely by the end of the year to see $60 to $70, meaning those old antique highs at 50 in 1980 and 2011, which are really sort of jokes. Because one, you were up there very briefly, like days, and back down. And when you do a real valuation, the degradation of the money unit since 1980, the increase in the M2, or since 2011 even, heck, gold would probably have to, silver would have to be $200 now to just match in real value terms those price highs we saw then. So it's catching up. And I think this surge will blow past those, what we call idiot highs. And at that point, what's going to happen? The public's going to say, oh my gosh, I missed this. I got to be in it. And so I think that's when you're going to see an onrush, fairly fresh, of money moving out of the doubting stock market into, hey, I missed this, I got to be in it. The gold, silver miners, and silver. And that's when you get this gush effect, the wet bar soap effect, where everybody's grabbing it, it goes up. And this is not unusual in markets anyway, but especially in these situations. I think we're in process right now, in other words.
History shows that during financial meltdowns or rapid fiat devaluation, gold often spikes as holders seek refuge. In past crises, central banks have deployed interventions like QE, yet gold eventually surged to new highs. The current environment, fueled by inflation, national debt, and destabilized markets, could set the stage for another powerful rally in precious metals, especially if digital instruments amplify accessibility.
Both when you measure silver relative to gold in the bull markets, like 1979, 80, or 2010, 11, silver versus gold was up in the 3.5% to 6% range price of gold. Well, that would mean relative tripling to get to the old bull highs on the spread. Let's say the 3+%. So, we're not right now well above 1%, but you get up to 3%. That would mean, well, I throw this number out a lot, and it's not a projection. I think you'll go way past it. But gold has had two bull markets in the last 50 years where it's gone up ninefold. Okay, if you go up ninefold this time, it means you're going to $8,500 gold, because our low is $1,050. Right. So a ninefold move from 2015 to, that's just replicating what you've done twice before. The circumstances this time are far more monstrous in terms of driving it much higher. The monetary crisis we'll face, the government debt crisis. So stopping at 8,000 is highly unlikely, but even if you went to 8,000, do a tripling of silver relatively, gold, silver would be at $240. Is that about right? So it's, the point being, when we go up there this time, also the events in the world, and in the street events, the academic notions about what works, what doesn't, policy changes, institutions collapsing, they'll be institutionalized again.
As legal tender laws expand and digital infrastructures mature, a tectonic shift in money perception is underway. Citizens may begin demanding alternatives to fiat, institutional investors could diversify into metal-backed assets, and policy might adapt to reflect new monetary norms. Whether this leads to a new parallel financial system, enhanced sovereignty, or even a future new monetary order, the resurgence of gold and silver signals that the age of paper-only money may be evolving.
And it won't be a shift to cryptos, okay? Because that jolt could happen. It's going to happen. Whether we get a crash out of Bitcoin or not, we're going to get a massive downside jolt. You don't build that kind of structure, in which case you look across the horizon and you say, well, there's only one place to be. And even governments will recognize that, and they'll make the transition because public demand. So that's why I think when you get up there the next time, don't expect it to implode. Expect instead more like a new reality, a new zone.
Before possibly a new Bretton Woods type moment, right?
Yeah, whatever. But I, yeah, the fiat currency competition, who run the dollar index, for example, that doesn't really show you the value of the dollar. It just shows you the value
Yeah.
of the dollar versus other pieces of paper. Okay, that are doing the same thing, just not at the same rate. Or as you said, if they cut rates, that's been helping the dollar hold up a bit better than it might otherwise have been. But when you start cutting rates, then you suddenly, you put more downside pressure on it because you have less incentive to own things in dollars and, et cetera, et cetera. So anyway, all these events are massive potential, not just fundamentally, but we see them technically. Forex, government debt markets, not just our debt market, but Japanese, et cetera. These are crisis type events. And when they unleash, the guys in charge you will find out they're not in charge. And when that reality hits people, that's when arms go up in the air